So, you've got a side hustle. Maybe you're selling some crafts online, writing a few articles, or just turning a passion project into a little bit of extra cash. It's what so many of us are doing these days. But that little bit of profit, well, it can come with a surprisingly big tax headache.
Okay, let's get right into it, because this is something that catches so many people completely off guard. You do everything right, you're honest, you report your income, and then bam, you get hit with a penalty you never even saw coming. So what exactly is it?
Meet the self-employment tax. It's a hefty 15.3%. And get this, that's on top of your regular income tax. See, normally, your employer pays half of your Social Security and Medicare taxes, and you pay the other half. But when you're your own boss, guess what? You're on the hook for both halves. For a small side gig, that can feel less like a tax and more like a punishment.
So how do most of us fall right into this trap? It's actually pretty simple. When you go to file your taxes, you put your side hustle income on a form called Schedule C, profit or loss from business. I mean, it seems like the logical thing to do, right? But the moment you file that Schedule C, it automatically flags your income as a business profit, which, you guessed it, automatically triggers that 15.3% tax.
And here's where it gets even more frustrating. Ever since the Tax Cuts and Jobs Act, the other option, calling your activity a hobby, has its own major problem. You still have to report every single dollar you make, but you can't deduct any of your expenses. So if you sold something for $100 but spent $80 on materials to make it, you're still getting taxed on the full $100. It's a classic no-win situation.
So it feels like you're stuck, right? You're caught between two really bad options. Pay a huge 15.3% tax as a business, or pay income tax on money you never even really pocketed as a hobby. But what if there's another way? What if the smartest move is to challenge that conventional wisdom entirely?
And here it is. This is the core of the whole strategy. On one side, you've got the common advice everyone gives you. You have to be a business so you can deduct your expenses. But the contrarian strategy completely flips that. If your side hustle has really low expenses, like consulting, writing, or other digital services, it's actually better to be a hobby. Why? Because avoiding that 15.3% tax is way more valuable than writing off a few small costs.
Okay, so you're probably thinking, can I just decide I'm a hobby? Well, not exactly. But here's the most important part. This isn't some shady loophole. This is a strategy that's completely grounded in decades of U.S. tax law, and it all comes down to how the courts define what a business actually is.
And it all boils down to this one crucial phrase from a landmark Supreme Court case, Commissioner v. Groetzinger. The highest court in the country decided that for something to be a real trade or business and get hit with that self-employment tax, it can't just be something you do once in a while. It needs to have, and this is the key, continuity and regularity.
So, what does that legalese actually mean for you and your side hustle? It's simple. Just because you earn some money from an activity doesn't automatically make it a business in the eyes of the law. If you're doing something here and there, sporadically, without a fixed schedule, and it's not your main source of income, well, you have a really strong argument that it doesn't have the continuity and regularity to be a true business.
Now we get to the really clever part of this whole thing. See, the IRS has a whole set of rules they use to catch people who are trying to pretend their expensive hobby is a business just to get tax write-offs. But we can actually flip those rules on their head and use them to prove our activity is genuinely just a sporadic thing.
This is the IRS's famous Nine-Factor Test. They came up with these rules to stop people from, say, claiming their yacht racing passion is a business just to write off the boat. They look at all this stuff to see if you have a real profit motive. Are you acting like a business owner? Do you need this money to live? The standard advice is to try and say yes to as many of these as you can. But for our strategy, answering no is the whole point. No, you don't have a formal business plan. No, you don't work on it every single week. And no, you absolutely don't depend on the income. You're not failing a business test here. You're passing the test for being a hobby. You're basically documenting that your activity is sporadic, which is exactly what that Supreme Court standard is looking for.
The IRS even has something called a safe harbor rule. Basically, they assume you're a business if you make a profit in 3 out of the last 5 years. But again, for our purposes, failing this test is actually a win. If you're only profitable here and there, say 1 or 2 years out of 5, that's powerful evidence that you're not running a continuous, regular business.
And if you need any more proof that this is a real, recognized part of tax law, here it is. This is an actual IRS form, Form 5213. Its entire purpose is to let people put off the decision on whether their activity is a business or a hobby. The fact that this form even exists proves this isn't some trick. It's a legitimate question that the IRS is ready to deal with.
Okay, so how do you actually put this into practice? It's way simpler than you might think. It all comes down to one single choice: which line on which form you use to report your income. It's a tiny mechanical difference that can have a huge financial impact.
This chart just lays it all out perfectly. If you file on Schedule C as a business, sure, you can deduct expenses, but you pay that painful 15.3% tax. But if you report that same income on Schedule 1 as a hobby, you can't deduct expenses, but, and this is the big aha moment, you pay zero self-employment tax. For any low-expense side hustle, that is a massive, massive win.
So let's be crystal clear about this. This is not some tax evasion loophole. It is a legitimate tax strategy. It's a tool that's grounded in legal precedent. But, and this is important, it's a very specific tool for a specific type of modern worker. It's definitely not for everyone.
This strategy is pretty much tailor-made for you if your side income is truly sporadic and irregular. It's perfect for things with minimal costs like freelance writing, coaching, or consulting. And most importantly, it's for people who have a day job and do not depend on this extra income to pay the bills. If your activity fits that profile, then it very likely lacks the continuity and regularity to be called a business.
And all of this leaves us with a much bigger question, doesn't it? The line between a job, a business, and a passion project is getting blurrier every single day. Millions of us are earning income in ways that just don't fit into the old 9-to-5 box. So, as the nature of work itself continues to evolve, maybe it's time our tax code's definition of what a business is evolves right along with it.